Ashutosh Bhargava joins in on the show right now from Nippon India Mutual Fund to talk about what his take on the market is. Ashutosh, hi, afternoon. Good to have you today on ET Now. While we're counting down to, actually not counting down, we're already there at 20,200 on the index. What's the word on the broader markets though? Do you think they're ripe for a correction?
Hi. So definitely, last 6 months, the kind of rally we have seen in the broader market, the price value gaps across many sectors, I think that has narrowed. So any untoward news related to either local factors or global factors, perhaps would mean that, overextended market in the short term are prone to some profit taking. So risk could be from right from slightly higher crude prices from already where they are, or some other, local news flow going into next quarterly earnings. I think the upside from the broader market at this point of time, after stupendous last 6 months, I think that seems rather limited to us.
Okay, so in your multi-cap fund then, have you changed your allocation in terms of what the exposure is to mid-cap versus, let's say, large cap? And also in terms of the cash levels, how are they trending?
Typically, at a house level, we don't take much of cash calls. We prefer to remain invested and don't take large cash calls in most of our portfolios. In multi-cap strategy specifically, we need to keep 25% of the AUM in all the three size categories. And there we have, rather than tinkering with the overall allocation in terms of size categories, we have looked to add some kind of defense in the portfolio, some defensiveness in the portfolio by incrementally adding more consumer names and booking profits in some of the erstwhile domestic cyclicals. We made a significant amount of profits. So we are trimming down on some of the cyclical names, adding some defensive in the form of consumer names and utility names. And that's how we are kind of, preparing ourselves for any potential bout of volatility there.
Ashutosh, I also see that you guys have managed to kind of play the industrials through a lot of these under-owned names, the likes of Kenna Metal India, Vesuvius India, and even Linde India for that matter is a large holding. What's the thought as far as industrials and these stocks are concerned?
So when we think of industrial, you need to also think about the alternatives that we have in the form of the global demand and global pricing related sectors. That's where our view is slightly negative. We think domestic cycle is relatively well poised versus the kind of challenges that we are seeing in broader global demand and global pricing environment. And within domestic demand, we think, CapEx is relatively better placed in terms of overall demand outlook as well as the pricing power. So consumption is something which is where we think there are some demand related challenges. There is higher competitive intensity. Wherein industrial, which is the kind of the remaining block in the market, that's where we see that, the order books of the companies are improving. The medium term outlook is incrementally becoming better across, equipment providers and even some of the infrastructure names. So on a relative sense, despite the run-up, we prefer to look at some of these capital goods stock where medium to long-term prospects remain still healthy, although some of the attractiveness are already priced in terms of higher valuations now. And therefore, we are incrementally, and some of the names that you're talking about, incrementally booked some profits and deployed that in relatively less cyclical segments like consumers and utilities.
Okay. So outside of these spaces, where is it that you are still recommending fresh buys?
So as a house, we have incrementally added positions in power sector in general. So utility companies, some of the lenders which are specifically into that segment. And we remain constructive on the equipment side, and other than the generation side, we are equipment side the transmission companies. We think, in terms of taking differentiated bets, and which is where as a house, in 2 or 3 sectors, we take a significant differentiated bets vis-a-vis the benchmark. And power is one segment. That's where we have recently added a lot of position across the sub-segment that I have mentioned, because we think we are at the start of a multi-year, power demand supply imbalance. And that's where you will see a lot of pricing power for the utility companies beyond the regulated segments. And also there will be a lot of demand related to capex. So we are trying to play this whole power story as a pack with these segments. And this is where we think even fresh money can be deployed from medium-term perspective.
So you have allocated, additional money to the power sector and see a lot of value there, and a multi-year upcycle is what you are talking about. But just wanted to come back to the point when you were saying you're trimming positions in cyclicals and adding it to consumption. But which vertical of consumption? Because staples clearly is not doing well. I do see a couple of hotel stocks in your portfolio, EIH, Indian Hotels, etc. Apart from hospitality, is there any other vertical in consumption as well that interests you?
We have incrementally added some bit in even in FMCG segment. There the idea remains that the input cost pressure has receded. In fact, there are some tailwinds that we are seeing. This being an election year, there is some bit of populism that is also there in the system, and which perhaps could help in the rural consumption or consumption at the lower income of these strata. So. And also, we were a bit underweight on these segments, and to provide some kind of balance to the portfolio, we are cutting down on some of the underweights in this part of the consumer segment. Apart from that, within the consumer segment, we continue to play premiumization through retail, QSR, some of the alcoholic beverages names, other than the hotel and hospitals that you could see in our portfolio. So, one end, premiumization of consumption that we have been playing for quite a long period, still remain constructive, but incrementally adding some of the basic consumption segments like FMCG, because we think this is a time that we need to take out some of the cyclical risk from the portfolio and add some balance to the overall portfolio. And this is the way we are playing it.
To chat with you. Thank you so much, Ashutosh, for taking the time out and speaking with us.